How Canadian business owners can stop losing money to taxes. Your RRSP and TFSA strategies that work. Now, are you a Canadian business owner or a real estate investor or an incorporated professional? If you're keeping investments inside your corporation, you could be unknowingly giving away thousands of dollars to the CRA and to Ottawa every single year. And it's not because you're doing anything wrong, it's because you're just not using the right tools. Hi, my name's Laurent Munier and I'm a partner and advisor here at Safe Pacific Financial. We're based in Vancouver and we help Canadian entrepreneurs and high-income professionals to build, protect, and transfer their wealth using tax-efficient, long-term financial strategies. And today, I'm going to show you exactly how to leverage RRSPs and TFSAs, which are two of Canada's most powerful personal tax shelters. You do this to protect your investment returns and accelerate your retirement goals. Now, where Canadian business owners are losing money on their corporate investments, well, let's talk about it. This is something that doesn't get nearly enough attention, but could be costing you tens of thousands of dollars every year. If you're a Canadian business owner or you're an incorporated professional or a real estate investor with retained earnings inside your corporation or inside your holding company, chances are you're investing those funds to grow your wealth. And that seems like a good idea, right? Well, here's the problem. Investing inside your corporation without the right strategy can lead to a massive tax burden and serious long-term inefficiencies. So you're investing inside your corporation, and this is a common approach for incorporated Canadians. You've built up the excess cash or the retained earnings inside the operating company or inside your holding company, and you want to make that money work, right? Who doesn't? But if you're not careful, you're walking straight into what's called the corporate tax trap. Corporate investment income is taxed at the highest marginal rate. So in most provinces, investment income earned inside a corporation is taxed at your top marginal rate, which could be 50% or more depending on the province you live in. Now this is high. And here's the kicker. Unlike personal investments in a TFSA or an RRSP, corporate investments do not grow tax-free. Instead, you're paying tax on your interest or your dividends or your capital gains every single year, and that eats into the compound growth. Another thing to look out for is passive income. So this passive income rule, anything over $50,000 a year can take away your small business deduction. And the moment that your passive income inside the corporation is higher than $50,000 per year, you start to lose access to the federal small business tax rate on your active business income. So that means instead of paying the small business tax rate, which is, 12, 13% depending on the province, your operating company could end up paying the general corporate tax rate of 27%, depending on the province, on any active income over $500,000. So this is, ballpark, an extra 15% tax because the government says you're a bad business owner who makes too much money. So let's give you a real-world example of this corporate tax, leakage. So let's say you've saved up and you've got $2 million in your holding company and it's generating a 6% annual return. Now, this isn't a ridiculous return. This is a standard, a standard S&P 500 ETF averages more than this. This gives you an annual $120,000 in passive investment income inside your corporation. So the corporate capital gains tax on that $120,000 is going to be around 30 grand. Plus anything over $50,000 reduces your small business deduction in the operating company at a 5-to-1 ratio, which means you lose $350,000 of your small business deduction. So now only $150,000 of your net income in the operating business gets the lower small business tax rate. The remaining $350,000 is taxed at the higher general rate. So for easy math, ballpark numbers here, that's an extra $52,000 in taxes in your operating company because you made too much passive income in the holding company. So you started with making $120,000 that year and you made it on your investments. This actually costs you about $82,000 in taxes. You keep 38 of the 120. That's crazy. I mean, of course, you're a big bad business owner and all of the problems of the world are your fault because you made money. So, taxes on corporate investing, they add up quickly. They add up a lot. And planning is definitely important here. Now, why does this matter for your long-term wealth? Well, many Canadian business owners don't realize how much money they're losing each year simply because they're not optimizing their corporate and their personal investment strategies. And this isn't just about today's tax bill, it's about reduced retirement savings due to inefficient compounding, or fewer investment dollars working for you in the long run, and more taxes paid to the CRA. That's less money in your pocket, and that's less money for your family. Now, when you add in market volatility and a lack of liquidity in many corporate accounts, the problem becomes even more urgent. So you want to have strategic RRSP planning if you're a Canadian business owner, and this is how you maximize the tax efficiency, and this is how you get the maximum retirement income. So when you're a Canadian business owner or you're an incorporated professional, you might not think of an RRSP as part of your financial strategy, but you should. RRSPs are not just for salaried employees. In fact, RRSPs can be one of the most powerful tax planning tools available to incorporated Canadians, especially when used strategically alongside corporate investments or your holding company and other wealth building structures. Now, why the RRSPs still matter when you're incorporated? So even if you earn most of your income through your dividends or you retain money inside the corporation, drawing a salary to create the RRSP contribution room can be a smart move in the right circumstances. And here's a few reasons why, right? You get the immediate tax deduction. So when you contribute to the RRSP, you receive a tax deduction that directly reduces your personal taxable income for that year. This is especially powerful if you're earning more than $165,000 a year, where your marginal tax rate, say in Ontario, is 47%, right? A properly timed RRSP contribution can save you tens of thousands of dollars in tax every single year. You also get the tax deferred growth. So inside the RRSP, the investments grow without being taxed. And that means no tax on your interest or your dividends or your capital gains until you withdraw, which is usually in retirement. So this allows your money to compound faster and more efficiently, especially when invested in a high growth thing like stocks or ETFs. You can also have the benefit of income smoothing in retirement. So you'll likely be in a lower tax bracket during retirement, which means that when you begin to withdraw from the RRSP or your RIF, you could pay less tax. And this allows you to convert high tax earnings today into low tax income tomorrow. So here's some planning tips for business owners. So as a business owner, this doesn't mean that you should max out your RRSP every year. We generally consult our clients to add to their RRSP on a case-by-case basis, on a year-by-year basis. So you want to maximize your RRSP contribution in high income years. So if you had a great year or you got a large bonus, consider drawing a salary and using it to max out your RRSP in that year. You can see whatever your max RRSP contribution is on the My CRA website. If you Google My CRA, it'll be the first link that comes up, and you can go in there and see exactly what the CRA says you can put in to your RRSP this year. You can also catch up on unused RRSP contributions. So if you haven't contributed to the RRSP in some years, you can carry forward the unused contribution room from previous years. So this gives you a powerful opportunity to make a large lump sum contribution and get a big tax deduction in one shot. You also could use your RRSP contributions to offset corporate bonuses. So we often help clients to draw bonuses from their corporations in high income years and to offset the personal tax using a strategic RRSP contribution. So this boosts your retirement saving and it keeps your tax bill lower. Generally, also, we're telling them to invest for growth inside the RRSP, right? So you're not limited to conservative investments. You could hold all sorts of things like Canadian or US stocks or ETFs. You could have dividend paying stocks. You can get bond ETFs or GICs, which is not higher risk. It's very conservative. But all of these assets will grow tax deferred inside the RRSP, which means that you don't pay annual tax on the capital gains or the income as long as the money stays in the RRSP. Now, let's switch gears a little bit, and here's how to maximize your TFSA in Canada. So this is a tax-free growth strategy for business owners and for professionals. So if you're an incorporated business owner, or you're a high-income professional, or you're a savvy Canadian investor, and you're not fully utilizing your tax-free savings account or your TFSA, you're missing out on one of the most powerful, flexible, and tax-efficient tools that are available to make money in Canada. So we love TFSAs. right? Whether you're planning for early retirement or you're building wealth outside of your corporation or you're preparing for future business opportunities, the TFSA deserves a prime spot in the overall investment strategy. Now, why is the TFSA so powerful? It was launched in 2009 and designed to help Canadians save and invest without paying tax on the investment income or withdrawals. So here's what makes it so effective. Number one, you get tax-free growth. So any growth, interest, dividends, capital gains, any growth inside the TFSA is completely tax-free. You don't pay tax when you withdraw the money from the TFSA. You also get tax-free withdrawals, like I just said. So unlike RRSP withdrawals, when you take money out of your TFSA, it's not taxable income. So that means you can access your money without triggering additional taxes or impacting your marginal tax rate. This also means there's no impact on government benefits, right? Since a TFSA withdrawal is not counted as income, it doesn't negatively affect your eligibility for income benefits like old age security or GIS, your guaranteed income supplement, when you're in retirement. This is a huge advantage for retirees that are looking to optimize cash flow without clawbacks. So there are TFSA contribution limits. So today in 2025, the annual TFSA contribution limit is $7,000. And if you never contributed before, your total lifetime available is $102,000. So this means that you could invest up to $102,000 inside your TFSA and have that grow completely tax-free. Now here's a plug. We can help you do this. We have a great portfolio manager who can help you to set up the RRSP and your TFSA and to make sure that you're properly invested. We would be happy to help you do this. Now, how do you use your TFSA as a strategic investment vehicle? So we help business owners, we help incorporated professionals to turn their TFSAs into a mini tax-free investment machine. And here's how. So you want to max out your TFSA contribution room, right? Don't leave TFSA space idle. Every year you don't contribute is a year you're missing out on tax-free growth. So if you have unused room from previous years, a lump sum contribution can catch you up and get all of your money working harder. Generally, we're advising clients to invest for growth, not just safety, but this would be entirely up to you. Your TFSA isn't just for GICs, so we recommend using it for growth. And again, like I said, it depends on your risk tolerance, but generally we're recommending things like Canadian and US ETFs, dividend-paying stocks. You can do REITs in there, like a real estate investment trust. There's all sorts of things you can put in your TFSA. So these types of assets have a higher growth potential. And then inside the TFSA, all of the upside is tax-free. Now, one thing to note is you cannot write off losses inside your TFSA or your RRSP. So you still need to be careful of the risk that you take inside these accounts. You don't want to lose money. You can use your TFSA for short-term or emergency liquidity. So do you need cash for a business expansion or for a real estate down payment or for a family emergency or just to spend, right? Your TFSA is penalty-free, tax-free. You can withdraw the money at any time and the room is recontributed the following year. So for example, you take out $50,000 from your TFSA this year, you can recontribute it back next year. You don't lose the room. You can also use your TFSA to supplement early retirement or semi-retirement income. So if you're planning to retire early or you want to shift into a part-time lifestyle, your TFSA withdrawals offer a great way to supplement your income without increasing your tax burden. So you want to max out your contribution room. You can use it for high growth or short-term liquidity, and you can tap into it for tax-free funds in early retirement or to invest in other things in business opportunities. Now, what can we do for you? So at Say Pacific here, we specialize in working with business owners and with incorporated professionals, especially if you've got a high income. We can help you to optimize your RRSP and TFSA strategy. We can balance your corporate and personal investments. We can create an efficient withdrawal strategy for your retirement. And we can also set this all up so that it preserves your small business deduction. And we can help you to build a tax-free legacy using insurance and advanced estate planning. So not to toot our own horn, but I think we do a really good job of managing investments for our clients. We have a CFA portfolio manager that we work with, and she's got a fiduciary duty to you. And we aim for what's called risk-adjusted returns on investments. So if this is something that's interesting to you, and to get started or to see if we can be a good fit to manage your investments, contact us through the website. The website is safepacific.com. There's lots of buttons there that you can click to contact us or to schedule a meeting time directly in our calendar. The first meeting is totally free and there's no pressure to do anything. There's no rush to do anything. We'll walk you through the best mix of corporate, personal investment strategies that are based on your current income, on your future goals, and on your risk profile. I'll also leave a link below the video so that you can schedule directly with us now. And before you go, if you got value from today's video, can I ask you a favor, please? Please click the like button. Please click the subscribe button. This helps the algorithm to share the video to more great Canadians like you. Smart tax planning isn't just about saving money. It's about building real financial freedom and legacy. So my name is Laurent Munier from Safe Pacific Financial. Thank you for watching, and I will see you next time.